Gervais Williams, Managing Director of Miton Group PLC, a long-standing fund manager, apparently 30 years in the business. I presume things have changed a little bit over that period. Have they gone from bad to worse? Or?
Yeah, they've certainly changed a bit.
Regulation?
I mean, yeah, I started in '85, so things really have changed a lot. I mean, when I was started, the small caps, typically most pension funds would have between 10 and 15% of their UK weightings in small micro. And currently it's about 1 or perhaps 0.
Well, that's right. I mean, I remember the first time I met you recently was at your book launch, The Future is Small.
Yeah.
And there must have been sort of, I don't know, £10 billion in the room, you know, just the great and good of the city. And I mean, you were saying that, and we sort of know that, you know, the small caps are the future, or growth companies, however you want to label them, or the AIM market even, if you know, nothing else, you know, if nothing else. But it's just, when you say it, it's still sort of, it's just difficult to sort of really latch onto that, because, you know, the liquidity doesn't seem to be there. Private investors love that area, or they love the one theme, but it's just not happening yet. When is it going to happen?
I think we are going through the most extraordinary period of change. I think it's just starting. I think it'll be with us for 20 years. I think this is a multi-decade change where it's just starting at the moment. It's hard to know kind of the exact moment when you could say it started, but I think we can already say that there is a major change going on. And I think the recent changes in the market, particularly in the last 3 months, with it sort of flying up and down, and particularly commodity prices, it's not just oil, of course, you know, iron ore and some of the other stocks, some of the other commodities come back. The fact that bond yields have fallen to extraordinary lows. I mean, you know, Japanese bond yields were low already, but they've halved again, you know. And, you know, UK, US, there's long bond yields being very low tells us all that it's going to be tough to make money for our clients. It's been tough to make money on our own investments in the next 10 years.
Yes, but on those bond yields, they're in the wrong place. I mean, they're being artificially kept to those idiotic, I would say, well, not idiotic, but they are dangerous levels.
Absolutely.
You know, and even it's like an Italian bond or a Spanish bond is, I don't know, it's at a rate. I mean, those countries are just a whisper away from going bust. Well, they are. You know, let's say they're effectively bust, though they would be.
Yeah.
So the bond rating is just ridiculous, and interest rates as well. They're also at ridiculous levels. Something's got to give at some point. You're saying it's going to be growth company, you know, small
growth. World growth is giving. That's what's giving. We've had the most extraordinary period where world growth has been very good for 20, 25 years. You know, we've all been borrowing growth from the future. The debt has been building up, and as we've been doing that, of course, it's been fantastic for any asset at all. Almost every asset has gone up. Certainly, you know, equities, housing, property, bonds, commodities, you know, fine wine, vintage cars. Just everything's shot up. It's been a fantastic period to make great capital gains. But unfortunately, now we're in the other side of that. Since 2008, you know, they have cut interest rates. They have expended a lot of money on QE. They have actually run, you know, substantial budget deficits to try and spill over the 2008 effect. And the net effect has been that world growth has nearly stopped.
But do you think that was the right strategy? Because when they did that, I thought, well, obviously I'm not somebody who's in the business as you are, but it just seemed to be wrong. It seemed to be unfair, and it seemed to be a recipe for disaster.
I think the reasoning was, you know, we don't know quite how it would have been if we hadn't done that. But certainly, if you look at the 1930s, what you saw is extraordinarily rapid falls in asset prices, you know, liquidations, and savage setbacks in GDP. And I think they were looking to steer away from that. And I think that's probably why they did it. And I think, in my own view, that they did save that sort of extraordinary period of adjustment being very concentrated. But I think we've got a much slower period of adjustment as a result, with very little growth, and with most pension funds and most investors, you know, sort of heavily weighted in the largest companies. Large companies are struggling to get top-line growth. Large companies' profit margins are near double where they were in 1985 when I started. And so we've got to expect very little turnover growth. Generally, margins will come under pressure. It's not just about supermarkets. It will be fund management groups. It will be lots of other areas of the market as well. So net, the really interesting thing which has happened in the last 6 months is that dividend growth has nearly stopped in the markets as well. So dividend growth has been going on as people have been buying in their shares, taking on a bit of extra debt to buy in their shares. But just in the last 6 months, we've seen not just the cuts in the dividends, but we've also seen now with the oil price coming down, certain oil stocks will cut their dividends. A lot of the mineral stocks will cut their dividends, and some of the other highly geared companies, something like Centrica perhaps, which has got a bit of oil but also a bit of utilities. Even Glaxo, I think, may cut its dividend in the next couple of years. So you've got all sorts of areas where dividend growth is stopping and coming back. And of course, that's one of the reasons why small companies will be the best performing sector in the next 5 and 10 years, bar none.
Yeah, but what type of small caps? Because from what I can see, if I was in your shoes,
sure.
In a deflationary environment, I'd be trying to pick out companies which have pricing power. It's very simple. It's just, you've got a new type of battery, you've got a new type of chair, you've got a new type of record. Anything artistic, creative, something like that. Those are the things, or like media companies maybe that they have an angle that. So just basically pricing power in a deflationary environment, it's got to be a winner.
Absolutely, of course, pricing power is everything. But what's actually happened, of course, it's not just some of those technology companies or those innovative companies. Yes, there will be some winners in that area, but there will also be many more winners which are just in a lot of the traditional areas which have not done well for the last 20, 25 years. Maybe manufacturing. I think manufacturing is looking pretty good, actually, in the UK. It's been under most enormous pressure. Anyone who's left in manufacturing in the UK is usually a very good business. And if you look at some of the big companies, when you look at their capex currently, they haven't got much to put capex into. They're really struggling to find the opportunities, and that's because they haven't got much turnover growth and there's not many opportunities of their scale. But little companies, say food manufacturing companies, for example, can still find certain projects which will give them a 3-year cash payback, or maybe a 6-month cash payback. Some of them are very short. They can put capex in, they can get the cash payback, but also they can improve the quality of their products, they can be innovative, they can bring new products to market. So Finsbury Foods reported results yesterday, I think. It's not a very exciting business. It's involved in cakes and breads and that kind of area. But its competitors are not investing, it is. And because it's investing, it's able to take market share, it's bringing innovative products to the supermarkets. You might think they might be under margin pressure, but if they bring innovative products to the supermarkets, they bring like-for-like growth. And that's what a supermarket wants more than anything. So they say to the supermarkets, I've got some new products, I can give you like-for-like growth, or I can give you a different supermarket like-for-like growth. And these supermarkets are falling over themselves to take these products. They're having to pay up. So you've got 6-8% growth in top line in Finsbury Foods. Margins sustained, possibly improving, P of 8, with a company which is yielding about 3.5, 4. Pricing power in an industry which you would have thought would have been absolutely savaged. But if you look really at the last 25 years, most food manufacturers have been dying because every year Mr. Tesco's or Mr. Sainsbury's would turn up and would say, I've got another 10% or 20% buying power. What's your best price for another 15 or 20%? And you'd have to cut your price. But now the boot's on the foot, not just in those areas, but across the industry. And it's the small companies which have the capex opportunities, and because they have the capex, they can grow the sales, cash flow, more dividends. And it's the dividend growth in the 60s and the 70s which drove small companies to outperforming year in, year out, despite, stock-go economy, despite inflation which shot up and high interest rates, despite industrial strife which we had, in spite of currency crisis after currency crisis after currency crisis, and a lack of world growth, small companies massively outperformed. They grew their dividends and they got the support of institutions.
But you're saying, for instance, with the Finsbury Food, they come up with some new type of product, which is a low-calorie steak and kidney pie, something like that, and they can go to Tesco and say, look, this is going to be a winner compared to whatever you're serving, you have on your shelves at the moment. That type of thing, but they're being very nimble, very proactive.
Yes, particularly one of the best growth areas at the moment is various specialist breads, artisan breads. More people are buying, specialist breads. It is more expensive than the ordinary bread. But if you're eating at home rather than going out to supper, people buy these breads, and that's driving like-for-likes for the supermarkets, and that's an area which they're expanding in the moment.
Right. I mean, one of the things about being a fund manager, it seems to be, almost like where do you begin? Do you have a sort of set pattern in terms of building up a portfolio, a spread of stocks, how many stocks? I mean, presumably people when they're at home and people try and do it themselves, obviously.
Yeah.
What are your sort of basic pillars in terms of, developing a portfolio and then deciding whether you're maintaining it in the right way?
Okay, I mean, one of the advantages of being an institution is that we do get great access to corporates, chief execs and management teams. And so we try our best just to have a ridiculously open door policy. We try and let just about, often 4, 5, 6, 7 sometimes face-to-face meetings personally in a day. So you get through very large numbers of corporates. And we answer very, very simple questions. Green and red traffic lights, it's not sophisticated. Is your top line going to grow? Are you going to sustain margin? Because if you're going to get both of those, the chances are you'll generate more cash flow next year, more cash flow the year after. We look for companies which are so safe at the moment because the world is very unsafe. We don't quite know what's going to happen next. Maybe Greek people will do the wrong thing next week, or the right thing. I'm not sure what the right thing is. But whatever it is, maybe there'll be some disaster because the oil price is so low that various countries fall over. I don't know. So we've just got to be ridiculously careful. So we go for ridiculously safe balance sheets, net cash or modest net debt, plenty of headroom to take the unexpected. And then the last thing is we look really mainly for recovery situations, companies which are on the floor. There's a lot of very good companies which are right up there, and sometimes they continue to go on for many years. But we all know that if you've got high expectations, it's a real hard thing to keep beating high expectations. And if you miss high expectations, you're in the lift shaft and the stock's down 20%, 40%, 60% or whatever it is up thereafter. So there's very simple things. Top line growth, sustained margin, strong balance sheet, discount based upon, in many cases, a disappointment in the past. Maybe it's been in the wrong sector or it's got something wrong, it's upset someone. And so those are the things we look at. Coming back to the portfolio, we build it up from a bottom upwards. So we've got no preconceptions about what is going to go up or going down. But we do have very few commodities because, for several years now, because commodity prices are spiky. They're more spiky than everything else. They spike up beautifully, but when they spike down, it's horrible. And when it spikes down, we didn't know when the spike down, if there was going to be a spike down, but we didn't want to be involved on the way down. And so we haven't got many commodities. So we have a little kind of eye out for anything which could just go horribly wrong. And so there's a sort of investment weather. We keep an eye out for the investment weather. And so at the moment, we're not expecting much growth in the UK. We're not expecting much growth around the world. Basically, we're looking for companies which can grow irrespective of the economy.
And sectors?
Sectors, we've got a lot in technology at the moment. TMT was very, obviously very fashionable in 1999, 2000. There's a lot of very good companies which are cash balance sheets, sustaining growth. And we had, I was just looking this morning, KBT, K3 Business Systems. It just had very nice figures, 20% growth. It's on a PE 14. Has got a tiny bit of net debt, but only about 10 million. Microsoft think their product's so good that they're selling it in the States. In terms of the UK, they've got this Axis, Microsoft's software, which is for logistics for retail companies. They can't keep up with demand. They're having to ask people to wait. So obviously we expect that to continue to do well.
That company is. I remember when I used to trade, say, for myself in the 90s.
Sure.
You see something like that, but the problem is by the time the news came out with 20% growth, etc., etc., the shares were so over. They turned out to be at such a premium.
Sure.
That was the high watermark.
Yeah.
It's a bit like Warren Buffett buying Tesco. That was the high watermark of Tesco. Yeah. He was, all the right lights were green then. It was sort of fantastic. Growth here, growth there, growth everywhere else. How do you guard against getting involved in the sort of the sort of hot air of the market, because there is so much of that?
Yes, routinely I sell far too early. So so there's lots of stocks. I am the one who sold Abcam to Harry Nimmo, who made billions out of it. We'd made 100% out of our holding, but he just took it up for the next 500% or 10,000% or whatever it was we got. But so we do sell far too early because we're just so interested in getting things which are recovery potential. Means that if you've got something with recovery potential where expectations are pretty nothing, then the chances are if it doesn't do much, nobody's really disappointed. You don't lose a lot. So it's very much stocks which are on their back, where there's opportunity. We like to see the green lights coming on. We don't always get it right. If we don't get it right, don't lose a lot.
That's the other point. If let's say Thomas Cook, I think they went, or Dixon's,
sure.
They went down to 10p, both of them.
Yeah.
Are those the sort of companies that you would be interested in, or is that just too hairy?
Unfortunately, with Thomas Cook, it just had a balance sheet which was too hairy for us.
And still looks like horrible.
I haven't looked recently, but yes, so that these are companies which are on their back, full of potential. They've got a lot of value in them, tangible assets often, net cash, perhaps stock. There's a lot of tangible assets, but they're not just being used. The business isn't focused. Perhaps the sector's wrong or whatever. And sometimes just a change in a management team can just drive these assets. And when they come right in massive size. Not all of them, but you've got a chance that they come right in massive size, and that's the opportunity.
So are you buying these stock? Once you made a choice, is it the whole amount which is at risk? You're buying this stock at 10p. It's either going to go to 100 or 200p, or it's going to go bust. I mean, are you in that position, or you're not in that position?
No, absolutely not. Most of my stocks have net cash positions. Some of them have small net debt, but they've all got huge cash, headroom. If they needed to borrow in a hurry, they've already got the facilities in place.
Right. So it's not.
So there's not much double or quits type of things. We aim. The other thing which I think we do quite a bit different from a few other fund managers is we just don't care about size. I just don't care if it's 2 million, 200 million, 2 billion. Most of my funds are sub 250 million, but we do look at £2 million companies. You might say, well, what's the point? We're never going to get serious weightings in it. But if it's a £2 million company, it's got a better chance of doubling than if it's a £200 million company. And certainly, if you do get it right and you get a couple of £100,000 into it, and it makes 400 grand for your clients, where's the disappointment in that?
And are you getting unsolicited offers and presentations all the time? Is that
you bet.
daily?
I mean, we're rung up about a lot of companies raising money, and obviously we see a lot of those. We see a lot of companies which are, for whatever reason, on the road talking. We see a lot of companies which we've already got holdings in. So, as I say, tens of companies come through the door every month, and hundreds come through the door every year.
And since the financial crisis, obviously the banks are not lending at all. Probably better because they don't actually know they never really knew when to lend or not to lend.
Yeah.
Is some of that falling onto your shoulders in terms of people, rather than knocking on RBS, they try and think, well, maybe a fund manager will try and...
We do have one fund which actually loans, that does convertible loans, maybe something like a loan stock with a conversion into a company. And those were very popular back in the 80s. They've not been popular for the last 25 years. They are becoming more popular. I've probably seen 4 or 6 this year to date of companies issuing, say, a convertible loan with a sort of yield of 7 or 8, with a conversion into the equity, maybe at a 25% premium or 20% premium. So you hopefully get a nice steady income. Of course, it can go horribly wrong. You can get caught out, but hopefully you've got steady income. And then if the company comes right through its investment, then you get the opportunity of participating in the upside if the share price rises more than 20%, say.
But given how clueless banks are generally, isn't it? It's probably right that you're more into that area, or you could go into that area because you have the expertise.
I think banks can be pretty useless, but they are going to relearn the lessons of the past. Lending 400 million to a private equity transaction can be very good business for banks because it's very industrial. You can do 25 of those transactions in a month. But the danger is if the private equity business doesn't get half of its cash back in the first 18 months or whatever, then you've got a very highly leveraged company. And if Mr. Merkel says the wrong thing and the market goes tits up, then basically you're on the hook as a bank for several hundred million. Lending 2 million to 200 little companies might be a lot of hard work, but if it's a quoted company, the chances are even if it gets into trouble, it might get a rescue rights issue, it might not. So you don't always lose your money. And if it is a bad day in the office, it is just one of your 200 companies. So from that point of view, banks will get back into lending. They haven't got there yet. It's another reason why small caps will go up, because they'll be more attractively financed in future than they are with probably overly conservative balance sheets.
Finally, sort of a cheeky question. I'm sure plenty of people in the audience are sort of soldiering on with their portfolios and balancing everything out, and they took a hit on Tesco and maybe wondering whether to buy Quindel, etc. Is there sort of like a 2 sentences or 3 sentences where you would say, this is why you should, apart from your track record, this is why you should consider being with a fund manager rather than having your own portfolio?
I'm not sure I would actually suggest you go with a fund manager. I think, what I like is the enthusiasm of direct investment. I mean, I don't think we should be embarrassed by that at all. Clearly, the advantages, if you did want advantages, are that they're more spread in a fund management portfolio. My portfolios typically have 100 or 200 stocks. It doesn't mean that I get it all right, but it means that when I get it wrong, it's not too bad, and when I get it right, hopefully, it's not a big change. But over time, if we get it right cumulatively, then we can make a lot of money. But I wouldn't dissuade you guys from actually being out there and doing it yourself, because we need to invest in small companies. We need to get away from the bigness of the small bigness. We need to get a lot of these big fund managers to start embracing smallness like they just hadn't embraced it for their entire career. They just got used to the fact that credit boom was there. That was standard for them. What they haven't seen is the change in pattern. They're beginning to get used to it. The Swiss franc and all the other things which have been happening recently have been most unpleasant for them. But that's only the start. It's going to happen again and again and again. All sorts of things are going to happen. I've got no idea what they are. But small companies have a better chance of growing than big companies. That's the start and finish of what we're talking about. They've got better balance sheets, better dividend cover, and everyone wants dividends now, so you're going to get them paying dividends. So you're going to get dividend growth at the small end of the market, which will drive the sector crazy over the next 10 and 20 years. And they're illiquid. So if you get cash coming from the big guys down to the small guys, it's just going to be caught into a pint pot. And the illiquidity they keep hating will be the illiquidity they can't get in, not they can't get out. So we're going to get the most, it won't be a straight line, but there will be a long period when small micro, not small mid, small micro, will be the best performing sector.
Gervais Williams, Managing Director of Miton Group, thanks for speaking with us tonight.
Thank you very much indeed.